on the nose, so we'll just go ahead and get kicked off. Thank you so much for everyone, to everyone for joining. If you are listening kind of afterwards here on our podcast, The Restaurant Boiler Room, thank you for tuning in and listening. We're very thankful for those who listen and subscribe to the content. You know, I've never done it for the purpose of making money, just to get good information out to the marketplace about the beloved franchise M&A industry that we've been a part of for so many years. So this is going to be a survey that we put out. We're here with Derek Ball, with Peter Fisher, and with Raymond Buehner and I, and we're going to talk. First time we've done this, so we asked 19 questions of buyers. You know, it's been a pretty volatile. Volatile is not the word. Maybe a subdued M&A market for franchise businesses, and really M&A as a whole over the last 3.5 years now. As a matter of fact, I was just told that April 2025, last month, was the lowest amount of M&A closings across all sectors in our country since the Great Recession in 2007 and 8. I think maybe 2009 was the time.
Yeah.
So it's been pretty slow. There have been some closings. We just, closed a big Taco Bell business a couple of days ago. We have 6 other assignments that we have active, which is really low for what we normally do. But we wanted to pause and ask the questions that we've never asked before in mass of buyers and potential buyers of franchise businesses, and let them opine and send out their answers. And I hope that this is a blessing and a benefit to everyone who listens here. So thanks again for joining us. And if you have any questions along the way, feel free to raise your hand. We'll try to answer them as we go, and we'll send out a link to our this content, which will be both on the Restaurant Boiler Room podcast on all platforms, and also on our website and our YouTube channel, unbridledcapital.com. And with that, ladies and gentlemen, let's get it going. So let's go to question number 1.
And just real quick before that, to the 49 people who responded to our survey, we appreciate you. Obviously, yes. We wouldn't be doing this podcast if it wasn't for your all's responses. We'll be doing this similar to our lender survey annually. So, in about a year from now, we'll send out similar or the same questions, and we'll be able to kind of do this annually and kind of see how buyers' minds are potentially changing year to year. But thank you to the 49 people that responded. And yeah, Rick, take it away. I'll go to the first question.
Yeah, sure thing. And well said. Thank you, guys. So the first question that we asked was, which of the following would best describe you as a buyer? And out of the 49 responses, we had existing franchisee with no outside capital, 47% of the people, well, 49% of the people, a little about half. Family offices were 16% of the respondents. Private equity were 14% of the respondents. Independent sponsors were 6%. Personal investors were 10%. And then former corporate franchise executives or franchisors were 2%, just one response, comprising the 49. So, gentlemen, what do you make of this as we get started?
About what we expected. Keep in mind, we don't know who responded. We didn't get the names of anybody who responded. It was all confidential. But generally about what I would expect, in terms of our deal launches, this is in line with the type of people who generally respond, signing our NDAs and looking at our deals. It's usually half people are just kind of owner operator franchisees of various sizes, and the rest are often some sort of institutional group. So about 50-50 here ish, maybe 60-40 if you include the personal investor as well. It's about what we expected.
Yeah.
Yeah, and I would say that this kind of overall lines up with what we've been saying for the past couple of years. The main buyers we've been seeing recently have been strategic buyers, and so that's kind of what we see here.
Yeah, I'd say this is pretty representative of our current buyer pool. Seeing over or nearly 50% being basically strategic. Those are kind of who are winning our deals right now. So I think it lines up with what we expected.
Yeah, I think so too. It looks pretty consistent with how I'd think about it. The family office and private equity group being around 30% is maybe a little light, but then again, the environment has not been as friendly to those types of buyers that, rely more heavily on, on new unit growth and low cost of borrowing and new unit development, like I said, and some of the traffic and sales increases that we haven't seen. So there may be a little underrepresented here, but a 60-40 split looks pretty good. How about question number 2? Let's go to the next question. Do you prefer to own the underlying real estate? There's somewhat of a scatter of these questions, so they may not be in exactly the right order, but just stay patient, and there's some really good stuff throughout here. So do you prefer to own the underlying real estate? And 51% of the respondents said yes, which I think was maybe a little surprising to me to have that high of a number. 25% more or less were indifferent, and 25% said, no, we do not want to own the underlying real estate. Any comments here from you guys?
Yeah, we usually say the owner operators are more interested in owning the real estate. I think based on that last slide, 30% of the respondents were PE and family office. And generally speaking, they don't want to own the real estate. I was a little surprised that the no might not have been a little bit higher. Maybe some of those family offices would be more indifferent to the real estate. I think generally private equity doesn't look at it as a great use of capital. So I would generally expect them to say no. So no, I think it's one of those things though. We tell a lot of our potential sellers, if they're looking to sell the real estate separately, we tell them, it might veto some of the buyers that would otherwise be interested in your business. I do think this kind of supports that comment, at least give the buyers the option to take down the real estate or not. It'll just bring more people to the table. I think this validates that a little bit.
Mm-hmm. Yeah, I think always an option to purchase the real estate is always a positive, even if the buyer doesn't want the real estate. You always keep it or sell it on the 1031 market. If you're in maybe a less desirable brand or region of the country, option to purchase the real estate could be key to getting a deal done as well.
Mm-hmm. Yeah, and for potential sellers out there, if you own the real estate and your business is maybe average to below average, including the real estate in the deal, is almost a requirement in some cases just to bring a buyer to the table. Not as important in some of the higher growth, maybe higher multiple brands, but for average or below average business, that's something you should definitely be thinking about.
Certainly agree with Raymond's comment. And we went through a kind of a dry run of this yesterday, and you made that same comment, and I really honed in on that. And so I'll just repeat that. That's the key learning I come away with here. If you operate a small to mid-size business, franchise business in a brand that's I don't want to use the word languishing, but just kind of a legacy tier 1 brand that's not overly, exciting from a growth perspective or attract a ton of buyers naturally, just know that if you go try to sell your real estate through a sale leaseback, before you sell your business, you're probably cutting out a lot of your buyers. And that's, it's just, you don't want to do that. You don't want to do that and be left with a business that you can't sell or have a hard time selling. It's just something to keep note of. Okay. Question number 3. Good stuff. Question number 3 is, do you currently own any franchise branded assets? Okay, so 92% said yes and 8% said no. So I look at this, I don't know what you guys think, but we're relying upon people to respond. So 49 people responded. Those are probably the people who are most interested in buying, businesses, right? And it's just a little bit notable that so few people who don't own restaurants, already responded. Maybe
this question was really just to get to know who was responding. We didn't ask names. There's confidentiality there. So just know, based on the responses we see throughout this, 90% of them currently own restaurants and a handful don't. I think this is just more of a get to know your respondent type of question for us.
Yeah, I agree. I think it just validates the responses that we got from the survey.
Mm-hmm, mm-hmm, mm-hmm. Yeah, may mean that we have fewer people not owning restaurants in the marketplace right now. But that's it's not perfect. So okay, question number 3. Let's go. Or no, we're at question number 4. Question number 4. And if you're listening but not watching, I know some people are on Zoom and certainly podcasts too. We do have a presentation that we're going to that we're going through that you can actually physically see, and it'll be on our website. So if you wanted to, kind of see the responses to these questions, you can tune into the tape delayed version of the webinar or go to our website, in the next couple of days. So for question number 4, how many brands do you currently own? This is an interesting one. So if you 0 brands, that's 6% of the respondents. 1 brand, 26.5%. 2 brand franchisees, 30.6%. 3 brand franchisees, 14.3%. 4 brand franchisees, 16%. And then 5 or more brands, franchisees that own 5 or more brands, you've got 14.3%, which is a pretty healthy percentage, really, and a nice distribution. Any comments here?
Yeah, I'd say, this response to this question, surprised me a decent bit. If you add up the percentages, over 65% of people who responded here own 2 or more brands. Which, tells me that there's probably increasing diversification among existing franchisees wanting to get into other brands.
Mm-hmm. Mm-hmm. Remember in the good old days when I first started getting into this business back in, I guess I started working for Yum in 2001. Yum was kind of like the big consolidator. They had 3 brands under their roof, and and they were doing multi-branding and stuff. And it was kind of I don't know to say it's a new concept, but many franchisees at that point were just single brand franchisees. It has changed a lot. I think first we had some innings in a baseball game of consolidation, and that still is ongoing always. But then you started seeing these large franchisees start entering a second brand and a third brand. And I think now, what I would note, and I guess you guys probably would agree with me, we talk to quite a few smaller franchisees even now who own multiple brands. They may own 10 of one brand and 15 of another, or 3 of one brand and 25 of another brand. Or so I think it's much more common. And it maybe looks a little bit more like a diversification play, like buying stocks, bonds, and mutual funds for, smaller, mid-size and larger franchisees to be diversified across multiple brands. Any other comments you guys would have?
Yeah, I think diversification is key here. If you got one brand struggling, you can offset it with another. And Rick, you laughed at my comment yesterday, but the farming analogy, I come from a farming background with my parents, and you don't see a farmer just growing one commodity. It's multiple, just to hedge against yields, pricing, weather, etc. So, and then many of you own just completely different verticals in your portfolio, not just restaurants, but others.
Yeah. Did you say the word FARMING again?
Don't make me do
that. Come on, man. He said farming. You know what I mean?
I said farmer.
What did you just say? Man, I love it. Mississippi. Yeah, Peter comes from a farming family in Mississippi. I see you got to tease him a little bit, right? He's good. You're good natured about it though, man.
All good.
Yeah, really, really good. I think that's a great point. And the point too is outside of restaurants. We'll talk a little bit more about that in a minute, about whether this diversification is happening inside restaurants only or outside restaurants. But I mean, usually historically, there wasn't much cross-pollination. It was either restaurants and more restaurants, or it was like fitness and wellness, or like the two didn't cross very much. We're seeing a little bit more of that now. I think that may be a new wave that we see a little more so in the future. Question number 5. How many units do you currently own? So our choices are, and again, an interesting distribution: 0 to 10 units, that was 16% of the respondents; 11 to 25 units, 18% of the respondents; 26 to 40 units, that's 6% of the respondents; 41 to 60 is 14.3% of the respondents; 61 to 80 is 10%; 81 to 100 units is 8%; 101 to 150 is 8%. And then franchisees that own 151 or more locations represented 16% of the group. So pretty even distribution, don't you think? What do you make of that?
I mean, it's not for us, in Unbridled, one of the things we talk about is, you don't only see us doing the huge deals. You don't only see us doing the small deals. We work across a pretty broad spectrum of assignments, from $5 million to 9 figures, from 5 units to well over 100 units. It depends on the deal. A lot of our competitors are kind of only at the top or only at the bottom. So I think this fits in terms of the types of buyers we talk to and the size that of buyers that we're working with and sellers that we're working with. So it's not surprising to me. I think we bring a pretty broad spectrum of people to the buyer pool, though. We're not only talking to the people looking to buy a couple of units. I think there's a question later that actually asks the buyers what size deal they're looking for, and it's fairly mixed as well. I think we have a pretty broad reach in terms of who we work with and who we speak with.
Mm-hmm. Mm-hmm. Yeah. Any other comments, guys?
I think it kind of shows, if you look at it, it shows that some are either new operators or don't want to grow above 25, while the majority of the rest were above 150. So it's like either stay small and maintain what you have, or grow it as big as you can.
What I gather from this as I look at it is we have a nice distribution. I mean, if you multiply these respondents by the number of restaurants, you're going to see that the overwhelming number of restaurants are held by the largest franchisees, right? However, the distribution of average unit per franchisee is pretty even across it. And that's what I've said for years about the cool thing about this business and the American dream that is manifested through franchising is you have all types of people, all walks of life, all nationalities, all different sizes, different geographies. And it really is represented here. You have small single unit, entrepreneurs. You have mid-sized legacy franchisees that have grown to a, still independently owned and operated, may have family involved, but are first or second generation. And then as you move down the list and you get into the larger sizes, you start seeing more institutional investors and larger multi-branded franchisees, and there's just room for everybody across the industry. We did get a question that popped up, and it was like, which are the top 3 brands? I was like, oh, great question. So I hate to be a tease here, but we're gonna answer that question. That's the last question we answered. Okay, we asked that question, and the person who asked this question, you should know that your brand's in the top 3. How about that? So that'll get you. Okay, so number 6, as a buyer, which franchise segment are you pursuing most actively? This is a good one, I think. Okay,
This was a check all that applies, by the way.
Yeah, so you can sum to more than 49, right? So yeah, and I don't know what we sum to here. Probably, I mean, someone did the math here. Probably 80. So average person probably responded to a little less than 2 answers out of the group. But quick service restaurants, 84% of the people responded that they are pursuing that segment most actively. Fast casual or casual dining restaurants, 22.5%. Health and wellness, 20.4%, pretty big number, really. So, there's something to learn there. Fitness was 14.3%, a little lower than I would have expected. Coffee and tea was 24.5 to almost 25%, which is a pretty big number. Actually, the second highest number on the survey here. And then we had an other line, which was 12.25%. What comments, guys?
I think it's not surprising that a majority of the answers did come in for the QSR, since that's the majority of what we market, and our audience reflects that. But I did think it was interesting that a lot of the responses were looking for non-food related concepts. This kind of goes back to the diversity thing we were discussing earlier for your portfolio. And so I just think that speaks volumes about that.
Yeah, I think the interesting 2 responses here. Obviously, we expected QSR to be number 1, but there's a pretty strong interest in health and wellness and coffee and tea. Several very hot coffee concepts. You think of 7 Brew and Dutch Bros that are kind of exploding right now. I think it makes sense that a lot of people are looking at those. And same thing with health and wellness. That gets back to the idea: are they not looking to add a second restaurant concept, but a health and wellness concept as a diversification play as opposed to a different brand? I think is interesting.
And the coffee could be a lot of Dunkin' as well.
Mm-hmm. Yeah. You would say Dunkin'. You would say 7 Brew is one that you're starting to hear a lot about, right? And they've had some pretty extraordinary results in many cases across the country, which is exciting to see. And they're really building out those models in those locations. I don't know if any of you've been there, but they're exciting. So is Dutch Bros. I mean, they have a pretty good following. I'm down in Miami at the moment, and I was at dinner last night with a guy who is invested in a 50 unit coffee chain in the Northeast mostly. I don't know much about it, but I just learned a little bit about it yesterday. So, and he says it's going gangbusters. So there's a lot of interest in the coffee segment. You're right. I mean, historically, when you think of franchising, I mean, the first thing you're going to think of is restaurants, right? They kind of built out the model starting in the 1920s and 30s. I guess it was A&W was one of the first ones, right? And then in California started the franchising trend that eventually moved its way back in the Midwest and then throughout the country. It's still that way. Probably 80% of the franchise businesses across the country are restaurants, but we do see these other segments starting to step in. I think there's something really unique and special about the health and wellness space. The problem is clearly that you have to start with something new. There's not a lot of existing, large multi-unit franchisees in that segment, but I think I've seen some concepts, I've seen some performance in this healthy lifestyle thing that really, I think Gen X is probably the group that's really kind of driving the spending and the discretionary spending towards health and wellness services. I think it's really that's something to watch for these next couple of future years. And how interesting would it be to see quick service restaurant franchisees marrying up their portfolios with health and wellness services, huh? And that would be that's some peanut butter and jelly, isn't it? You know what I mean? Any comments? Okay. Let's see. How are we looking on time? Let me pause for a second. So we're looking pretty good. Okay. Question number 7. Describe whether you are currently in the market to buy franchises. Okay, this is good. This is an interesting one. So one response, 37% of the folks said absolutely, looking aggressively and would like to close a deal this year. Excellent. The second group is almost 31% of the respondents say actively looking, might or might not buy a business this year. So we're almost at 70% people really want to buy a deal. Okay. Yeah, I mean, that might fly in the face of what you're seeing on TV and what you're hearing in the marketplace. Okay. Big learning here, I think. We'll talk more about it. Looking but unsure on current market valuations, unlikely to buy a business this year. That's only 2 people, 4% of the respondents. Selectively looking at a few brands, but not too aggressive. That's 8% of the respondents. And then mostly on the sidelines, unless it's a great strategic fit, 16%. Finally, not looking is just 4%. So not looking and selectively looking, not looking, but unsure are kind of out the door. What do you guys kind of say to this?
I would expect the people that respond to this survey to maybe skew toward active buyers, since we kind of marketed it as, asking current buyers the market, but it's a little surprising to me. I guess what I've been saying the last few weeks is there's still a little bit too big of a gap, I think, for most deals to get done. I think the buyer expectations on multiple and the seller expectations are still a little wide in most cases. I think this year alone, we've taken, I think, 2, maybe 3 assignments, and we've done 25 to 30 valuations. And generally speaking, if we don't engage, it's usually due to a valuation gap. And it's just where the market generally is. I think if that gap closes, if it's a quarter turn in both directions, I think you'd see a boom in the market in terms of deal flow. Mm-hmm. Bringing expectations about 10% closer. So it's not extremely surprising, and we get calls from buyers all the time looking for deals still. There's just not a lot out there, because while buyers want to buy deals, they are being a little more selective, and they're a little more price conscious. It's not 2021 where you just throw a 6.5 or 7 multiple on anything. It's just not where the world is these days. So I think you've got a lot of buyers out there, and I think you have a ton of built up seller demand. If that valuation gap just closed 10 or so %, I think you'd see a ton of deals closing and coming to market.
Yeah. I mean, we give an example, like the few who choose to go to market right now, who have businesses that have been doing well, like I think this year, I can just think of like 2 Taco Bell deals and a Wendy's deal that we've put on the marketplace. I mean, those had gangbuster responses, right? I mean, this recent Wendy's deal had, I don't know, there's a big Wendy's business we had on the market. I'm thinking 8 or 9 offers on the business and good valuations. So the Taco Bell business we had recently on the market had over 10 offers and high valuations. So there is lots of buyer interest here, and this kind of says that we're looking. 70% of us are looking for a deal. It's just, I think there's not, like Derek says, enough deal flow in the market that's healthy deal flow that's likely to close. I mean, the bad thing is sellers are often tempted. Think about buying a house. Sellers are often tempted, if they think they might be ready to sell their house, they throw it on the market and put a high price on it, and then it doesn't sell, right? It's like the worst thing you can do. So I think sellers are tempted, who might want to be sellers now, are tempted to put their business for sale, even though their performance may not be great, or they want more than what it's really worth. The market knows when they see the business that, how serious it is really, really quickly. And it's kind of a damaging situation if you put your business up for sale and then you have to pull it away because it doesn't close. Our competitors, frankly, do a lot of that type of work where they just put it up and it doesn't close, and then they tuck it back in their pocket and no deal is made. But I think it is, once we do find a little bit better of a market, and then the second comment would be, if you do have a business, just know that there are buyers out there who want to look at it, and the supply demand curve is definitely in your favor if your performance is strong enough to meet your expectations.
That doesn't mean if your business is worth 4.5 to 5 times, you're just going to magically get 6. The buyers are still going to be selective on what they're willing to pay. So there's just still that little bit too big of a gap in most scenarios. But here's question 8, Rick.
Yeah, and well said. I think we're gonna actually ask the question about what buyers are paying in terms of EBITDA multiples in a minute. So question number 8 is, what is your opinion of the macroeconomic environment in the next 12 to 18 months? So we have very positive, 6%, mildly positive, 20%, neutral, 37%, mildly negative, 31%, and then very negative, 6%.
This was asked, just for context, this was asked in the middle of when the stock market was cratering and the news was negative, and it was everybody, the world is ending, tariffs is killing everybody. I mean, this was, I think, sent out like right in the middle of that. So I bet you if we asked this again today, it would be skewed a little more positive, is my gut, just based on the timing of when we asked this. There's some color, sorry.
Yeah. Any comments, any other comments you'd make to this?
I mean,
generally speaking, people are pretty neutral or mild. There's very few. There's only 6 total responses out of 49 that are either very positive or very negative. Generally speaking, it's kind of skewing in my mind toward neutral, maybe slightly mildly negative. There's a few more responses for that than mildly positive, but generally speaking, it's actually a little less negative than I would have thought, especially based on the timing of when we asked it, which I think is a good sign. It tells you that buyers are still, somewhat positive or at least neutral on the state of the market.
Yeah, I agree. I mean, while 30% are mildly negative, that's not necessarily doom and gloom outlook. Only 3 of the responses were worried about it, and the rest were neutral or bullish or positive on the future. So, I view these results as very positive, especially given when we sent the survey out, like you said.
Yeah, I mean, this is definitely encouraging given the context. I mean, even, when the stock market's down 15%, there's very few people that were extremely negative. And if we did ask this a month later, I bet it would be skewed more positive than negative. So definitely encouraging for potential sellers out there.
It's a barometer too. Let's make sure we remember that this is an overall barometer of like the M&A kind of the juice in the M&A market, right? The more positive this pie chart looks over time, I would say the more just healthy M&A activity you're going to have. So if we ask this question every 6 months and charted it, when you see it, improving to the positive, you're probably going to see more deal flow, better same store sales, better traffic in the stores, like all the good things that you'd want to get deals on the market and get them closed. Okay, question number 9.
And just for a heads up, we've got the graphs and the spreadsheets. I think our eyes at Unbridled gravitate toward the spreadsheets better. So sorry if your eyes weren't on the graphs. You can pull this off our website after the webinar. Go
Yeah.
ahead.
I'm the old guy, so I'm going to put on some reading glasses here, as I look at these small charts. But so question 9 says, outside of price, what's the most important selection criteria for you in acquisitions? We had 5 answers here. Far and away, number 1 was the brand. And then a distant second was geography. And then kind of a third place was existing acquisition opportunities. And then distant 4th and 5th are going to be existing management team and new unit growth opportunities. What do you make of this, guys?
It's quite a bit different from a handful of years ago where people, I bet you new unit growth opportunities would have been second on this list.
Yeah.
But given costs these days, it's just taken a pretty big back seat. Existing management team, not surprising. If you're an outside group looking to make your first acquisition in restaurants, existing management teams usually pretty important, but that's not the majority of people we sell to. The majority of our buyers are existing franchisees, whether in that brand or another brand that already have a management team. It's just not usually that critical for most buyers. Brand being number 1 is not surprising. Geography being number 2 is also not surprising. People do want to be able to roll up opportunities, but that's kind of a distant third. So.
Yeah, go back to your original comment about the new growth opportunities. We compare it to the existing acquisition opportunity. The existing acquisition was number 3 on the list, and unit growth was last on the list. Most brands acquiring stores has become a better, more affordable option, rather than unit development. But we'll touch on that a little bit later as well.
But it goes to show brand is king. If you're in a struggling brand, it's an issue, whether you have a premium business in that brand or not. The brand and the quality of the brand itself, far and away the most important criteria when you're selling a business. And there's some things, if you've got the number 1 business in a struggling brand, unfortunately for you, it's just not going to usually save the day. It's not going to get you that premium multiple in our opinion. And I think this shows that.
Yeah, there's a huge gap between the brand being the most important selection criteria and then everything else. I mean, like the brand was like 4.5 out of 5, and then second was geography at 2.9 out of 5. So a massive difference between the brand and everything else. Go ahead, Raymond.
I would just say this also tracks with, the current buyers and respondents. The bottom 3 answers here are more important for the financial buyers, the PE and family office groups, which frankly aren't in the marketplace today like they were 3 years ago. So the fact that these are the 3 least important, I think tracks with who's actually buying businesses today.
Total opposite. 3 years ago, you could hear people say it, couldn't you? I can't pay 10 times EBITDA for a Taco Bell. I could build them for a third of the price of that or half of the price of that. Now it's quite the opposite, isn't it? It's like I want to buy some because it's too expensive to build, and I have too much competition. So it's just been a big switch over the last 3 years or so. Okay, well, let's go to question number 10. Which type of acquisition situation do you prefer? And we have 3 answers. Number 1, acquire a top tier assets that are best in class, typically at a higher relative multiple. So really good businesses at a high price. That is less than 25% of the respondents. Get this, but buy an average business with some operational upside for an average price. Bam, 61% of the respondents here. And then buy distressed bankruptcy kind of businesses at a below average price, only 14%. So what do you think?
Most existing franchisees want to use their operational expertise and their knowledge and their management team, and bring a little bit of upside to the table. It's nice to have that A+ operator with great sales and great EBITDA, but at the end of the day, you're unlikely to be able to improve it. And some people like that, like showed here, about a quarter of the respondents like that. But most people want to be able to improve it. They want to be able to buy something with 3 million of EBITDA and turn it into 4.5 million of EBITDA. Not buy something at 4.5 EBITDA and hope it stays there. So it doesn't surprise me. I think you know, it tracks with the deals we do. You know, we sell average businesses, we might get 10 offers. We sell top tier businesses, we might still get 10 offers, but you would think there would be kind of a delta. You know, you'd think there'd be more for the top tier, but there's just not. So still a lot of interest in just the middle of the road average business.
No doubt. I would say this too, and this is, I mean, I feel like a broken record here talking about the private equity and family office groups, but they tend to buy into a brand, consolidate around them, and then if they do decide to sell their business at some point, they're typically squeezing every line item in the P&L for every 10 basis points. I mean, they're so focused on the financial returns, perhaps maybe overly so, you know, at the expense of sales, right, and operations. But they're tracking down to a tenth or 0.2 of a point on every item on the P&L. But when you have a P&L that's really, really, really optimized like that, what you have to remember is, you know, you certainly want to operate that business and collect the cash from it. But when you go to sell it, people typically, unless it's a premier brand, don't want to pay a full price on a maximized P&L. So it's just a common theme here that we see these private equity based businesses. We look at doing an evaluation for them. They're really tight on their margins and they want the max multiple. And it's like the collection of the two put the thing 30 to 40% out of range for what most buyers are willing to pay. And you know, it's going to take high profile distress situations and private equity guys holding on to their businesses for way longer than they thought in order to kind of wash the country of this kind of thinking that you can just take a business, tighten down the hatches, and then sell it for a huge multiple with like no P&L upside. It's just not realistic for most cases, you know.
You're going to get a better overall price. Your just relative multiple might be a little bit lower. If you're focused on the multiple, you're going to be disappointed. But if you look at it and you just compare the actual, you know, EBITDA times the multiple, your price is still going to be better. But if you're focused on a prideful high multiple, it's usually not there.
If you have a business that has, you know, 23% margins and the average in the country for that brand is 18% margins, and the average multiple is a 7, don't expect a 7. Expect maybe a 5.5 or a 6.
We're going to start moving a little quicker. We've got 9 questions left in 21 minutes. So we'll start focusing on a few of these questions a little more.
Okay. Yeah, it's good. I've probably been rambling too. Number 11 is what type of brand best suits your acquisition profile? Super high growth, low unit count, 6%. High growth, large unit count, 25%. Modest growth, low to mid unit count, 27%. Legacy tier 1 brand, high unit count, 35%. And then struggling legacy brand, mid to high unit count, 8%. Comments?
Yeah, I think it just go ahead.
Peter. No, I'd just say this is consistent with the response to question 10. You know, it's difficult to close, you know, really high growth deals, and it's difficult to close, you know, near bankruptcy deals. You know, people want average businesses where they can, you know, recoup the upside. So I think this tracks with what people are looking for.
Very good. Okay, no other comments. We'll speed it up. Number 12. Which segment of restaurants most interests you for an acquisition? Okay, now we stacked them all up, and you could rank, so you could answer first place, second place, third place. Okay, so it's not just a linear response here. Chicken was far and away the highest. Second place was a clear Mexican, and third was a clear coffee. And then you had sandwiches, then burgers, and then there is a decent drop off down to pizza, and then desserts. What do you guys make of that?
Yeah, not much surprise here. I mean, the chicken concept, it has many platforms available to choose from. You got Wingstop, Popeyes, KFC, you know, Raising Cane's, some chickens. But it's interesting that Mexican is right next behind it, because this is mainly toted by Taco Bell, if I had to guess, and versus the many options for you know, all the chicken concepts that you can you know, run. So yeah, I thought that was quite interesting.
Tells me that maybe we had 11 Taco Bell franchisees respond to our survey. Because like Peter said, Mexican surprised me a little bit, simply because it's pretty much, you know, Taco Bell and nobody else from a national QSR perspective. You know, Chipotle you can't own. So the Mexican surprised me a little bit. Chicken's not surprising just based on how many massively growing brands are out there in the chicken space. And then you've got the big legacy brands too. Coffee, I think it's kind of the I don't know, the rage right now. Dunkin' you've got, which is just a classic coffee brand, does really well and has for a long time. And then you've got the new ones growing. Sandwiches and burgers being kind of right in the middle, not surprising at all. Those are usually largely kind of right down the middle average QSR concepts, usually between those two brands or two concepts. Pizza and desserts at the bottom is not too surprising. A lot of people are scared of the pizza wars, and then desserts a lot of people view as fads. Being at the bottom, whether that's true or not, a lot of people view it that way. So I think it's an interesting chart. I don't find it too surprising though.
Big difference between chicken and burgers. Just look at those two, quite a difference, I might not have expected that big of a gap between the two. Okay. 13th question is, what size of a franchise business would you be most likely to acquire? And we asked this by EBITDA. So we had between 1 and 3 million EBITDA, we had 37% of the respondents want a $1 to $3 million EBITDA business. $3 to $8 million EBITDA is 43%. So that's really our biggest group. Well, our biggest group wants a $3 to $8 million EBITDA business. $8 to $12 million EBITDA business, 10%. $12+ million EBITDA business, 8%. And so I would just kind of throw in here just real quickly what I've been saying for quite a while in this marketplace, particularly with fewer family office and private equity groups. The large EBITDA businesses just appeal to fewer folks. And the multiples typically, unless it's a handful of really, really strong brands, but even in that case, in most situations, the higher EBITDA businesses actually sell for a slightly lower price than these businesses that are kind of in this $3, $4, $5, $6, $7, $8 million EBITDA range, because those are the type of businesses that the average buyer of can afford to buy and can do so fairly easily and get a traditional bank loan for. Any comments, guys?
No, I think this probably would have been a little different, back in 2021, where you had 2.5%, 3% interest rates and everyone was wanting to build a little bit more, and the private equity and family office were out there. It's not surprising to me. The $1 to $8 million is where most people can afford. The majority of people we work with, now we work with the family office and PE groups that can afford the $100 million deal. But the majority of franchisees just can't take down deals like that. Whether they can financially or practically, or whether it's smart for them to grow that quickly or aggressively, they just can't really do it. So 80% of people want 8 million or less in an ideal world, which tracks with what we're used to hearing.
If you're a family office or private equity group, my only thing is to tell you is it's okay if the model that you created when you decided to consolidate in this business was to build something up to $30, $40 million of EBITDA and then sell it to another private equity group. It's okay that model doesn't really work in almost all situations now. Every phone call I get from someone who has a business like that now, I say, you got to sell it in pieces. And most of the time, the franchisees look at me and say, no, that's no way, and then guess what happens? They put it out there, for sale in a big EBITDA, and then no one offers anywhere near what they want for it. And then they come back and they say, you were right. So the model is not a model of build it up to $30, $40 million of EBITDA and sell it. You don't have the buyers anymore for a business like that, unless it's super, super attractive.
Now, keep in mind, and in terms of people that were responding to this survey as well, I don't disagree with anything Rick really just said, but the big, private equity groups that are wanting to buy $500 million companies or, 50 million plus of EBITDA, they're probably not the ones responding to this survey, to be frank. So yeah. It might be a little skewed away from them, but what Rick just said is true. We've had plenty of people look at him like he's crazy, and regardless of what he says, that's usually the look we get. And then
so whatever I say, people think I'm crazy. Is that what you said? They just look at me and say, "You're crazy, Rick." You know what I mean? Oh man, that was good.
All right, we got 6 questions left in 15 minutes.
What is the most common price range in which you expect franchise assets to transact? 3 to 4 times EBITDA, 8%, 4 to 5 times EBITDA, 39%, 5 to 6 times EBITDA, 33%, 6 to 7 times EBITDA, 8%, and then 7 or more times post G&A EBITDA is 10% of the respondents. Comments here?
Yeah, I'd say a few years ago, we rarely quoted below 5 times. And as you can see here, almost half the respondents think it should be the typical multiple should be less than 5. 2021, I'm not sure we did a deal below 6. So you can just kind of see, generally speaking, very few respondents here. What, 9 people out of 49 thought the typical multiple should be 6 or more. So to anybody out there thinking my business is 6, 6.5, 7, better be a premium asset. Otherwise, you're going to be in that 4 to 6 range, depending on the stores you're holding. So
for this one, show the graph real quickly. And go ahead, Peter. Somebody, yeah. This may be for visually.
I think it ties directly into the question we mentioned earlier. I think it was, what type of acquisition situation do you prefer? And for that one, I think 60% said they preferred to buy in at an average multiple. And here the top answers were about 70% for the 4 to 6 times range. So that's what we would consider an average multiple here. So it just ties in and validates that question as well.
Historically, this probably graph goes around 5 times, 5.25 times EBITDA, and that's historically over a 20-25 year period what most assets sell for in our space. Take the highs and lows out. Okay, 15. Question number 15. How would you fund an acquisition? And hold on here. The best question's number 19. So don't, but we'll deliver it on time here. Small print here. Number 1, personal loan, personal down payment plus a bank loan. That's 29%. Recapitalizing your current business, unlocking embedded equity. It's 27%. Existing family office or private equity money plus a bank loan. That's 37%. And then, then NA is like 8%. So thoughts here as well.
Yeah, I view the 2 answers, personal down payment with bank loan and recapitalizing your current business, is most likely the same kind of buyer. And that's a strategic one. It makes up over half of the list. Family office and private equity represent 36% here, but only 2 of them haven't identified their outside equity yet. So overwhelming majority here are ready to purchase for the right opportunity.
Yeah. Thing I'll add here, if you're a seller, in all likelihood, you prefer to be one of the first 2 options buying your business. Just with the third option with the private equity or family office buyer, that typically requires multiple sets of approvals. And just, from experience working with both buyers, we know which one is more likely to go smoothly. Which is typically why, family office buyers or private equity groups with financial money, are usually slightly higher in their price in the past. And that's why a lot of those deals are closing with those groups.
Yeah, well said. Very well said. 16. What is the most important when considering a brand's franchisor? For those of you who are thinking of getting into a new franchise brand. Number 1, general market reputation for being reasonable or difficult to work with. Boom, number 1, and there ain't no second place. If you're a franchisor who's not reasonable to work with, you're not going to attract the right franchisee. Number 2, franchisor's attitude towards new unit development. The third on the list was clarity and flexibility on remodeling obligations, and then descending order, of course. Number 4 is turnover of corporate staff in recent 1 or 2 years. And then number 5 is non-compete with other brands and companies. And then the least consequential is the personal guarantee on the franchise agreement. Go for it, guys. What do you think?
Yeah, I like this one quite a bit. It's just an obvious and very clear, number 1. If you're a franchisor out there and you're kicking butt, you can be unreasonable. You've got a right to do it, depending on what you consider a right, I guess. But you can do it and you can get away with it and still get good franchisees. If you're an average brand, which we'll get to here in about 3 questions, and you're being unreasonable, you're just vetoing all the potential good franchisees that want to come into your system. There's a lot of franchisors out there that just can't get out of their own way. That would just, I think, kick butt if they would just get out of their own way a little bit. I think this answer proves that point quite a bit. Franchisors' attitude toward new unit development is a clear number 2 as well. New unit development is just tough right now. 5 years ago, when you could go build a QSR asset for $1.5 million, you know, that's great. Now that it's $2.5 million, if you're pushing big development obligations on people, you're going to scare them away. Same with the remodeling obligations. Some brands are really good about having very clear plans. Some aren't. And it's tough for a buyer to underwrite a deal when you don't know if you've got a $500,000 remodel coming up on all your assets in the next 3 years. The bottom 3, I think, are pretty clear. Personal guarantee. People getting into these brands know they got to sign a personal guarantee usually, so it's not a surprise. Same with the non-compete. Once you make the decision to get into, say, Popeyes, you know you're going to sign a chicken non-compete. At minimum, turnover of corporate staff. It seems like that's just the norm these days. So not much of a concern. But if you're a brand and you think you've got a reputation for being unreasonable, and you're an average brand not kicking butt, like a few of them out there, you know, maybe look in the mirror and see if you think that's you.
It's pretty pitiful. I make a comment I should probably not make about the corporate staff of a lot of these franchisors. It is a revolving door. And who operates these brands anymore? I mean, they put, in many cases, you know, partially qualified people who stick around for 18 months or less. It's like, what's the point? You know what I mean? Why am I paying royalties for that type of advice? So we'll keep going. Question number 17. What would be the most likely reason you walk away from a deal post LOI? 5 answers. Number 1 reason would be the business is dropping in sales and profits. The number 2 answer, closely on its heels, is the franchisor is asking for too much new unit development or excessive remodeling requirements. A distant third would be seller is unreasonable and slow during due diligence. 4th place is franchisor is too strict on personal guarantee, non-compete, and other general franchise agreement terms. And then finally, in way 5th place, is negative change in macroeconomic environment. You know, probably not much really to glean here other than the most important thing when you get into a deal is that your sales and profits are not tanking. During due diligence, I've been famous in saying this over the years, that if, you know, your sales are down more than 5 or 6%, you know, during due diligence, and I think I usually see 7%. I don't know that I've seen too many deals in my career that have actually successfully closed. So you have to protect that as a seller and time that a little bit if you expect a successful result. Everything else other than just getting whacked by the franchisor with tons of new unit development pretty much is not as important. And let's go to number 18 since we only have 7 more minutes. Number 18 is, what is the most concerning trend when you are considering an acquisition? Number 1, traffic declines dominates, okay, the industry. That's the most important for people. Number 2, heavy remodeling versus the return of the remodeling. Number 3, the ballooning cost of new unit development. 4 is the expensive and difficult labor market. The 5th on the list is food cost inflation in the past 2 or 3 years. And then way down there is difficulty in finding capital and loans, which is good news. It means that there's still plenty of liquidity in the market. People aren't concerned about that. Any quick comments here on this slide?
I would say that, you know, finding liquidity and capital being last is probably the most encouraging thing from this question. You know, it shows that buyers, you know, I think you hear a lot about how it's a much tighter lending environment than a few years ago, but based on this, what buyers are telling us is that's not the concern for them when they're looking at an acquisition right now.
Yeah.
Yeah, I think those top 3 answers were, you know, we expected that. The one I found interesting was the expensive and difficult labor market, you know, it being towards the bottom. You know, 3 years ago, I think people would have said that this was higher up on the list, but pricing's come up to kind of offset the expensive part of it. And the difficult part, the labor part of it, you know, it's kind of become a new normal, and people are just kind of getting used to it now. So a couple of years ago, they would have been higher, but it's, you know, kind of towards the bottom now.
Mm-hmm. Mm-hmm. Got to get traffic back. Got to get sales and traffic back. I'm hopeful across probably 3 or 4 brands just that I've talked to franchisees in the last week, you know, here, you know, they're doing a little bit better in the last couple of weeks here. You know, when you're looking to find some positive results, sometimes you just look week to week, you know, maybe a little more than you should, but we need to get the traffic up. We need to get the sales up, and then the deal flow will start cranking, you know, because the EBITDA will be higher. And keep in mind, most sellers sell their businesses on a trailing 13 period or 12-month EBITDA. So we want to have some strong historical, EBITDA and traffic and sales in order to get the best price. Okay, our final question today, which I think is a really good one. Let's take some time on this one. And it's question number 19, which is to rank these restaurant brands in order of what you would be most likely to acquire as a franchisee.
Now, keep in mind, we couldn't list 50 brands. We picked, what do we have? I think 13 brands here that are generally pretty regular in the M&A market. We're not taking up and coming brands that have 100 units but are growing fast, like Seven Brew's not going to be on this list or something like that. So keep that in mind. We had to kind of selectively choose which brands we included here.
And I wanted to put health and wellness or something in fitness or other brands on here too that weren't restaurants. But since 86% of the respondents in a prior question said quick service restaurants were what they wanted, we just stuck with the restaurant question here for the final question. So your choices were, and you ranked them, okay? Well, I'll just go through it. The number one brand, far and away higher than anybody else on a different planet, really, is Taco Bell. Okay. So far away, I mean, it garnered a 10.6 response. That's kind of an arbitrary number. The second place was a 7.6 response. That's a huge drop, right? So number two was Wingstop. Number three at 7.0 is Dunkin'. Number four is Wendy's at 5.57. So there's like Taco Bell is by itself, and then you have Wingstop and Dunkin' are pretty close to one another. And then you have Wendy's, which we're going to see here is kind of by itself too, in fourth place. And then Pizza Hut was fifth at 4.37. Popeyes sixth at 4.29. Sonic also sixth, tied for sixth at 4.29. Papa John's was eighth at 3.98. Little Caesars 3.94 in ninth place. 10th was KFC at 3.63. 11th was Arby's at 3.57. 12th was Burger King at 3.47. And then last was Hardee's and Carl's Jr. at 1.88. If you take Hardee's and Carl's Jr. out at the very bottom, you certainly see a coupling of a lot of brands around, really close to one another. So I wouldn't get too worried about where you are in that list in kind of the middle there, because they're really close to one another. What do you guys think? Comments? We got a few minutes.
Yeah, between Pizza Hut and Burger King, it's a very small difference. Really, you could probably ask a different group of 50 people and have those mixed up a little bit. Yeah. But what it says is they're just kind of in that average space. They're going to be in, we had a multiple question earlier. Where do buyers expect multiples to trade? The biggest spot was 4 to 5 times at, I think, 39%. You had a pretty big gap there, or another 36%, I think, at 5 to 6 times. That's generally where these brands are going to be. And I think what's important is have something that maybe stands out. If you're in one of those brands, you're going to need something that stands out. High sales, high EBITDA, strong management team, potentially, even though the question before kind of showed that's not critical.
Real estate, maybe.
Real estate, potentially. Yeah. Good geography is going to be critical for these brands. If you're in these brands and you're in a tough state to do business, it's going to ding you a little bit more. So you need something, if you're in this grouping of 8 brands or a brand similar to these brands, you just kind of need something to stand out in the market in order to potentially get your price higher than you might otherwise want.
Yeah.
I would add negative EBITDA locations to that list as well. How many of your stores are underperforming out of, say, 100 stores if you have 20 underperforming locations? So I would say that's a big positive as well.
Yeah.
But this is in line with what we see. We usually talk about a handful of brands there at the top. You could throw that with Taco Bell, Wingstop, and Dunkin'. We often say Wendy's is kind of in a no man's land.
In a good no man's land,
and not in a bad way. It's obviously of the others, but it's going to have a little premium of a multiple over these other brands. And then you've got just a big grouping of legacy franchise concepts that are still sellable and attractive assets, but you need something to maybe separate yourself from the field a little bit in order to get the most eyeballs and the most interest.
Yeah, great.
I think it goes back to brand reputation here too. You can see it at the top. And those typically have the best brand reputation.
And that's great. I really appreciate this. This is a very interesting, question. And thank you guys for your participation, Unbridled team. Really appreciate your insights, all three of you. And for those of you who tuned in, listened, watched today or in the future, thank you for subscribing and listening. We'll send out copies of all this information. It'll be available at unbridledcapital.com on our website and on our YouTube channel. And if you have any questions or you want to talk about buying or selling or financing franchise businesses in or outside the restaurant business, we're always happy to help you. And so thanks so much, guys. God bless you guys, and have a good day, huh?
Thank
Sounds
you,
good.
Take
everybody.
care.
Thanks, guys.